Ladies and gentlemen, welcome to the Global Landscape of Climate Finance 2017 webinar. This webinar will be presented by Padraig Oliver, Senior Analyst at CPI. The format of this webinar will be a half-hour presentation followed by a question and answer session. All attendees will be on mute, but during this time, you're welcome to submit questions by typing them into the chat box on the lower right-hand corner of your screen, and we'll address them after the presentation. As a reminder, the webinar is being recorded and will be available online after the event. And now I will turn it over to Padraig.
Thank you, Caroline. And thank you everybody else for coming to join us today for the launch of the Global Landscape of Climate Finance 2017. This is the first time we've published an update to the landscape of climate finance since 2015, so we're quite excited to give you our numbers for the years 2015 and 2016 that we've found. But first, a quick word on who we are at the Climate Policy Initiative and our work streams. Our tracking work stream is the focus of today's webinar and aims to capture the current status on how public and private sources of finance are interacting at global and national levels. Our effectiveness work stream looks at how policy and public finance support can most effectively scale in private capital, including through looking at lessons from in-depth project case studies and investor needs. And finally, our transformative finance work stream is where we apply many of our lessons and methodologies to help design and run innovation programs for new climate finance instruments globally, but also nationally in India and Brazil. If you're interested in this work, there is a webinar tomorrow on the latest updates from the lab programs that have mobilized almost $1 billion in public and private capital to date. And just a quick run through of our agenda. We'll start off today looking first at the scope of finance flows that we're going to talk about, and then we'll go into the various breakdowns of this edition of the Global Landscape of Climate Finance, including the public and private actors, the instruments, the sectors, and the geographical splits, and then we'll end with some time for a Q&A. So in defining the scope of the work, it's useful to start with the objective, which is to provide a comprehensive overview of new annual flows into low carbon and climate resilient interventions. This means we track financial commitments, that is when an investment decision has been made at financial close or similar, and not when the actual disbursement of the funds may occur over a project lifetime. It also means we focus on primary transactions, ideally at the project level, and this can include investment into new assets or activities such as capacity building or support for policy development. It's important to remember that we are aiming to have a non-double counted aggregate figure for climate finance flows, and this has a significant effect on what we track. For example, we do not include risk mitigation instruments such as guarantees or insurance in the total flows. We don't include policy-induced revenue support such as feed-in tariffs. We don't include secondary market transactions such as non-project bonds, mergers and acquisitions. And finally, we don't include investments in manufacturing and sales because such investments are recouped through the project investment costs that we track. And here is our spaghetti diagram, our snapshot of the most recent estimates on global annual climate finance flows. It reached $410 billion on average over 2015 and 2016. So the numbers here represent an annual average over 2015 and 16. We'll be going into the annual differences shortly, but just to talk you through how the chart works. On the left, with sources and intermediaries, include public actors such as governments, their agencies, development finance institutions at the national, bilateral and multilateral level, and climate funds. And on the private side down below in the bottom left are commercial financial institutions such as banks, direct investment by investors, funds, corporations, households and project developers. Next along the flowchart are instruments. They constitute grants and different forms of debt and equity, either concessional at project level or backed by balance sheets. The public or private nature of the recipient of the investment flows is next, followed then by the end uses in terms of mitigation and adaptation. Beyond the spaghetti, we'll be going into more detail on specific sectors and geographies too that are not reflected here. In terms of the annual 5-year trend, we see that climate finance flows reached a record in 2015 of 437 billion, followed by a 12% drop in 2016 to 383 billion. Taking into account normal annual fluctuations, the average flows across 2015 and 2016 at 410 billion, as we showed earlier, were still 12% higher than the average over the previous period, 2013 and 14. And now for the detail. We're first going to look into the public and private actor commitments specifically. Here is the annual estimates for the previous 5 years. And here is the public and private split. As you can see, private sector investment grew to 299 billion in 2015, which was 68% of the total, before dropping back to 242 billion in 2016, which was 63%. Increased private sector activity is a sign of maturing markets, which require less public support to drive investment. But at the same time, steady public investment continues to provide a good foundation year after year. In 2015 and 2016, public finance actors committed between 138 and 141 billion US dollars, or in average 34% of the total climate finance flows. We were particularly interested in seeing if there was a Paris effect due to the increase in 2015. That is, if there was a recognizable difference due to the actions and announcements by governments taken in the lead up to the Paris Agreement at the end of 2015. And in fact, the increase was rather because of more private finance flowing due to falling technology costs and continued strong policy environments, rather than any significantly more public finance effect, as we've just seen. That said, behind the numbers, we were able to identify some signals that momentum may have made a small difference in two ways. First, we found that there was more direct investment by institutional investors. This figure went from 1 billion to 3 billion in 2015, and they may have been mobilized through the various investor engagement initiatives. A second, the Green Climate Fund has come onto the scene, replacing much needed low cost or risk taking capital as other climate funds reduce their spending. The Green Climate Fund has committed 2.6 billion US dollars to date in projects. So what actors are the most prevalent? On the private side, despite the note that we just made about institutional investors, project developers are consistently the main drivers of the largest volume of private finance, seen here in red in the graph. They accounted for 148 billion in 2015 and 125 billion in 2016. Developers in China, the UK and the US were the most active in sourcing finance for projects in their own countries. Corporations and households consistently account for about 10 to 15% of the total private finance flows. On the public side, development finance institutions accounted for the majority of public flows, around 89% of the total public finance over 2015 or 2016, or 124 billion. These institutions are shaded in dark green at the bottom of the graph and are in three categories. The bottom box is national public finance institutions, and then there are multilateral institutions such as the World Bank, and then bilateral development finance institutions. National development finance institutions reduced their commitments by 13% over 2015 and 2016 compared to the previous period, 2013 and 2014. And we found this was largely due to economic volatility and currency fluctuations in many emerging markets, and sometimes also partially due to different accounting methods used over the periods. In addition to the Green Climate Fund, some new actors were also captured for the first time in our landscapes. And these include the Asian Infrastructure Investment Bank and the New Development Bank, who provided a combined 2.5 billion in 2016. We also looked specifically at how multilateral development finance institutions have performed against their 2020 targets. In the lead up to Paris, these targets were set ranging from 25 to 40% of their total business to be through climate finance lending by 2020. As of the end of 2016, these institutions are collectively already more than 3/4 of the way towards achieving those goals. Now onto our instrument breakdown. This year we've actually sought to shake things up a bit on the instrument analysis. Typically, balance sheet financing is the largest instrument we've tracked. That is shown in the orange portions from the years 2012 to 2014. But this year we've applied a debt to equity ratio at the project level based on country and technology considerations to effectively split up the balance sheet financing into balance sheet debt and balance sheet equity shares. We found that market rate debt at 219 billion a year on average during 2015 and 2016 is the most important financial instrument used to channel climate finance flows. Specifically, project finance debt driven by project cash flows comprises 35% of all flows. That's the top box in 2015 and 2016 in red. And balance sheet debt, typically raised by corporate actors and project developers to finance new projects internally, accounts for 19% of the total across 2015 and 2016. So together, these two forms of market rate debt constitute 54% of the total flows. Low-cost or concessional debt provided by public actors such as climate funds and development banks accounted for 10% of flows across 2015 and 2016. These are shown here in dark grey. This was a reduction from 17% by comparison with the 2013 and 2014 period, and that we think is when national development banks in particular were more active in financing projects. Equity was the next largest instrument at 31%. We found balance sheet equity investments comprised 22% of the total, whereas equity investments at the project level represented 9% of the total commitments. Grants, many from public institutions, came in at 3% of the total, consistently year after year. In the interest of time, we're going to go straight to our end uses and sector analysis. You can see on the Sankey itself that investment in climate mitigation is 93% of the average annual climate finance flow, and renewable energy in particular is 74% of the total, 410 billion. When compared to other forms of electricity generation, we found this was double the fossil fuel power investment in the same period. The investment in solar PV and onshore wind specifically has led to deployment levels that mean they are on track to meet the modelled annual requirement set out in the International Energy Agency scenarios that give us a 50-50 chance of limiting global temperature rise to 2 degrees. Nevertheless, this is just one part of one sector across the whole economy where investment is needed. For energy use in power, transportation and buildings, the needs total over 1 trillion per year through 2050. And even more is needed in agriculture, forestry, water and waste to enable a low carbon transition, while adaptation finance to minimise the cost of climate impacts is also needed. Much of that capital that is needed may yet come from a shift from high carbon activities. When we add the total upstream and downstream investments in the fossil fuel sector, in addition to the previous electricity generation figures, we find that total fossil fuel investments amounted to 825 billion in 2016. That's according to the International Energy Agency. We think much of this may be wasted capital in potentially stranded assets in the future. Trends in public finance flows are important to track in order to show if finance is going where we need it. On the mitigation side, it reveals a shift in priorities. Energy efficiency is now the leading focus. The sector received 35% of public mitigation flows over the period compared to 24% in 2013 and 2014. This is critical to overcome hurdles in realizing the significant potential of energy efficiency. Public spending on renewable energy, on the other hand, decreased by 11 billion on average, suggesting that renewable energy is becoming a commercial investment choice in many markets. Sustainable transport also saw an increase in average annual investment from 19 billion in the previous period to 22 billion from over 2015 and 2016. On adaptation, our estimates show that despite ambitions within the Paris Agreement calling for a scale-up of adaptation finance, overall finance flows to the area remain a challenge. As a proportion of the public climate finance flow, adaptation flows decreased from 18% overall during 2013 and 2014 to 16% during 2015 and 2016. This is largely due to a reduction of up to 50% from the National Development Bank category. Some of this is due, of course, to an overall reduction in activity from national development financial institutions, but also we noticed behind the numbers some significant methodological changes in how adaptation finance is tracked. This underlines the need for better metrics and greater harmonized understanding on how to track adaptation finance. But it's important to note also on this point that multilateral development finance institutions have actually stepped up. They've increased their adaptation financing by 29% over 2015 and 2016 compared to the 2013 and 2014 period. Of the adaptation sectors, water and wastewater management captured 51% of public finance on average during 2015 and 2016. This was down from 57% in the previous period. Land use adaptation in the form of agriculture and forest management has increased from 11% in the previous period to 19% of adaptation finance in 2015 and 2016 to 4 billion. And other disaster risk management interventions such as early warning and rapid response systems have increased from 7% to 11% in 2015 and 2016, or 1.9 billion to 2.4 billion per year on average. Such investments will become more valuable to reduce the impacts of climate change over time. For example, the recent hurricanes in the US, Harvey and Irma, have estimated costs of 290 billion in economic damages. Turning now to our geographic source and destination of flows, we estimated 79% of finance was raised and spent in the same country. This yet again indicates the persistent importance of strong policy and regulatory frameworks in unlocking investment at scale. More specifically, by geographic regions, we found that in non-OECD regions, East Asia and Pacific remains the largest destination for climate finance with 132 billion per year, or 32% on average of the flows over 2015 and 2016. This was an increase of 24% over the previous period, 2013 and 2014. But in terms of who was the largest mover, we saw that South Asian flows saw the largest rise by 48% over the time frame to now reach 22 billion. In OECD countries, Western Europe and the Americas saw increases of 11% and 28% to 107 billion and 52 billion respectively. Flows across Sub-Saharan Africa, Latin America and the Caribbean remained static, while Japan, Korea and Israel saw a decrease of 29% to 27 billion I should say. So those are our numbers, and while there has been progress in tracking climate finance, there is still much work to be done. Data limitations and gaps, particularly on domestic government expenditure on climate finance, and private investments in energy efficiency, transportation, land use, and adaptation hinder our ability to capture a full picture. And this can have some effect on our findings, for example, skewing many of the private finance findings towards renewables. As to the future outlook for climate finance flows, we want to point to 4 promising trends in particular. Firstly, the Paris Agreement means the majority of nations are working to implement climate plans, and some of these plans also include investment pathways. In particular, we think the fact that Article 2.1c of the Paris Agreement includes a long-term ambition to make finance flows consistent with a pathway towards low greenhouse gas emissions and climate-resilient development. The articulation of this long-term and systematic finance goal in an international agreement can bring focus to efforts to engage the financial system actors, as well as efforts to ensure domestic government spending as a whole is consistent with a 2-degree pathway. Second, a number of initiatives are engaging broader capital markets, the financial system, and large corporations to align with low carbon and climate resilient development. We find that tools, investment criteria, and frameworks to assist investors to embed these low carbon and climate resilient practices are becoming more commonplace. Progress to date includes over 300 corporations have committed to set science-based targets on their emissions profile in line with 2-degree scenarios. Also, the Task Force on Climate-Related Financial Disclosure, established by the Financial Stability Board, launched its final report in June 2017, emphasizing the need for investors and asset managers to implement scenario analysis in assessing the physical and transition risks to climate change, as well as the opportunities to create investor value over the long term. And also, we note that the implementation of Article 173 in French legislation has led to French-based investors requiring reporting on portfolio alignment with low-carbon transitions. This underscores the potential for more active regulatory environments governing asset allocation by investors in this area. Third, efforts to green existing public finance flows are beginning to take root. Since 2011, efforts by these public finance institutions have contributed to greater transparency and clarity on levels of funding for low carbon and climate resilient development. And new metrics and tracking are being developed in line with the Sustainable Development Goals and climate generally. However, we still note that many more sectors need assistance. Particularly significant adaptive capacity is required in water supply, agriculture, and general infrastructure. In addition, fossil fuel technologies continue to receive some public funding, cancelling out some progress. Lastly, new investment vehicles are on the rise, and many of these target institutional investors that manage a significant portion of global capital. As we track new and primary investments into projects, we therefore do not capture the refinancing, acquisitions, or public offerings, and as a result, these large institutional investors and asset managers who operate primarily in these markets make up less than 1% of our total landscape flows. However, through initiatives like the Global Innovation Lab for Climate Finance and others, investment opportunities tailored to these investors are under development and implementation, with a focus on opportunities in energy efficiency, water, land use, insurance, and adaptation. So before we hand back to the Q&A, we'd also like to highlight a report that we published in collaboration with our partners at SE4All and World Bank about 6 weeks ago, where we specifically applied our landscape methodology to financing in the energy access space. This report catalogued and analysed investment in electricity and clean cooking from two perspectives. Firstly, the global approach, led by CPI, looked at investment in 2013 and 2014 across 20 high-impact countries, mostly in sub-Saharan Africa and Asia. These were called high-impact countries because together they accounted for 80% of those living without access to electricity and clean cooking. Secondly, the country approach, led by the World Bank, looked at three countries in more detail: Kenya, Ethiopia, and Bangladesh. And here is the landscape view of that finance for electricity access across those 20 high-impact countries. We found that 19.4 billion per year was invested in electricity in these countries, and about 6 billion of that is estimated to have benefited the residential sector specifically, as shown in yellow flows on the very right of the graph. This is well short of the 45 billion per year estimated needs for residential electricity access. You can see also how the residential flows in yellow is divided into 5 tiers of energy access. And here is the overview of what those tiers mean. They mean specifically the quality of the access the investment has enabled. Not all electricity access is created equal. A solar lantern may provide light for a few hours a day in Tier 1, while a household connected to a grid-level system may be able to use multiple appliances such as televisions and refrigerators all day in Tier 5. And we found that the bulk of the finance committed provided Tier 3 access or above, that is to say at least 8 hours of electricity per day with the ability to power medium wattage appliances. Here is also the equivalent analysis but for cooking, and the key point here being that only $32 million in annual finance for clean cooking was identified. This falls far short of the estimated $4.4 billion per year required to bring about universal clean cooking access, less than 1% of the total amount required. And now I will hand you back to Caroline for the Q&A.
Thank you very much for your attention. As a reminder, you can download the full global landscape of climate finance 2017 report and explore the interactive on the CPI website using the link I will soon post in the chat box. And now we will move on to questions. Our first question is regarding development finance institutions. Do national institutions include public retail and/or commercial banks, or just public development?
So we define national development finance institutions as institutions that are state-owned by a national organization and are spending domestically. So they are typically, to answer your question directly, public development banks only.
Great. Our next question is, why did private investment fall in 2016? Would you say the international community is not doing enough? Are there any tools that can improve
So the reason for the fall in 2016 is a two-part story. It's obviously linked to the rise in 2015 in some way. The drivers are similar. We found that in 2016 technology costs continue to fall, so that has an overall effect on investment figures. You get a greater value for your money when you have lower technology costs. So the overall size of the project investment costs can drop. But also we did notice a lower capacity addition, particularly in some countries. And we found this was driven by some policy changes that were coming to an end in 2015 in China in particular. There was a wind feed-in tariff policy that was due to close at the end of 2015, so this caused a lot of a rush of project investments to reach financial close in 2015, and so there was a bit of a hangover from that effect in 2016 that led to lower capacity additions in renewables in general. And so those were the two main sources of the fall in investment, the lower technology costs and lower capacity generals in lower capacity additions in general. In terms of saying if the international community is doing enough, again, it's hard to actually measure what enough means. In this context, we can only take the numbers as we find them from different actors and report them against the absolute need. We find that it's good to focus on the global investment needs that are needed across the economy, across all the sectors globally, as the main kind of purpose of this report. And so we have found that from the data that we can track on primary transaction level, new additional financing into productive assets, there is some progress being made, especially in onshore wind and solar PV sectors. The investments being made in that area are now up to speed in terms of the deployment rates that are needed to give us a good chance of staying within 2 degrees. However, they are only two solutions of many, many solutions that are needed across the whole economy. And so we still need to scale up investment significantly in many, many other areas. And then the final question there was, what are the tools that can speed up and improve the share of private actors? I guess this is also something that might interest you for tomorrow's webinar on the lab, where the focus is exactly on the deployment, the design and the deployment of those tools specifically. They include many risk mitigation instruments such as guarantee mechanisms, structured fund, currency hedge risk instruments, a lot of different instruments that address specifically investor needs and investor risk perceptions to invest in these low carbon climate resilient solutions across the world globally, but also in developed markets too.
Thank you. Do you include premiums paid for extreme temperature and/or precipitation in microinsurance policies and adaptation financing?
Thanks for that question. We do not yet include any insurance flows. We are looking into that area particularly. We're eager to get as much more coverage in our methodology as possible, as long as we can make it comparable with other data to make sure that we're being robust on the figures. But as insurance is something that may or may not pay out, the premiums themselves could be judged as investment costs as well, but it's something that we're happy to look into in the future, given the accurate data on it.
Could you elaborate on the methodological changes that have impacted adaptation accounting?
So in our various data sources that we use when we compile our landscape figures, we include data from many different actors. We include data from private, confidential or proprietary databases, as well as surveys to different institutions, as well as some publicly available data through OECD and other sources. And often the numbers on adaptation finance are a little bit inconsistent from different reporting sources. And so we found that in some years people they're able to identify clearly the adaptation component of the investment that they're looking to make. And sometimes they can only identify adaptation finance as per a positive technology list. And so we've just noticed in many different sources that some of the changes in the flows year on year are due to these differences in tracking from the institutions themselves rather than in any specific increase or decrease in adaptation financing itself.
Do developing countries include investment pathways in their NDCs? Are they investment grade? Do they have the capital markets and capacity to?
Some developing countries, we understand, are looking to develop these investment pathways that are linked to their NDCs. We don't know, we haven't looked in the scope of this report, in the scope of this analysis, how much of them are investment grade. We have analyzed many markets through the lab when we have developed some specific solutions, whether they be structured funds or climate finance instruments in particular, that are targeting some implementation in these countries. And we have looked at whether capital markets have the capacity there to deliver against the instrument that might be deployed. So, for example, one fund in particular was looking to issue domestic investment grade bonds to the domestic capital market. So it is very much a case-by-case basis on the solution and the need of the sector.
Is it possible to adopt an integrated approach for projects which include both adaptation and mitigation to attract more funding?
We do track projects that receive dual benefits, what we call, where they are financing, where some of our sources report investment into projects that have both adaptation and mitigation benefits, and they don't want to split it up between one side or the other. So that typically and regularly accounts for about 5 billion to 6 billion of flows each year in our landscape database. Whether these types of projects should attract more funding is a question. I think as we get better at defining what adaptation and climate resilient investments should be and are, I think that would make a big difference to the amount of financing that these type of investments can attract, that would bring in both adaptation and mitigation elements.
Could you elaborate on public finance from developed countries to developing countries? What is the share of UNFCCC funds?
So not quite sure what UNFCCC funds you might be referring to. We haven't got a percentage figure, but we did track about 2 billion of funds from the Green Climate Fund, for example, in 2016. That made a significant difference in the climate fund category that we track. It went up by 45% from the 2014 period due to some of the actions of the Green Climate Fund. Our geographical split is also split up based on OECD and non-OECD members. So we have some figures where we're in the report where we're able to assess what is the amount of flows going from OECD to non-OECD regions. We found that about 12% of the total flows, or 48 billion a year on average, went from OECD to the non-OECD countries. And this was almost the same, 11% as the previous period. So that includes both public and private financing flows that we're able to track.
Do you have any sense of the private stake in adaptation finance? The general conclusions seem to be dominated by mitigation investment.
Yes, so that is one aspect where we still have significant data gaps. As we showed in the graph earlier, we're still missing many private investments into adaptation. These are very difficult to track to make them comparable with our other sources of data on the public side, where in many cases the specific investment component related to increasing the adaptive capacity of the project is reported rather than the total investment cost in the specific project. So we don't have too much sense on the private side in adaptation. It is something that we will be looking at in the very near future. We have some reports that have looked at it qualitatively, especially in the water sector, on our website as well from in previous years too. But it's something that we are looking to get into more detail in future.
What insights do you have on the $100 billion goal for public and private finance?
So that's a very good question, an important question. We frame this report as more broader than the 100 billion goal in terms of looking at the overall need, and the overall need being trillions rather than billions. The two record-breaking years for renewables in particular, solar rooftop and onshore wind, indicate that we're more or less on track in terms of this need. But that's only one piece of the pie, as mentioned earlier, across energy efficiency and other areas. With regard to the 100 billion specifically, there's no agreed definition on what should count towards this goal. So we focused this report, therefore, on the global climate finance flows data in particular.
What policy measures would have the biggest impact in catalyzing flows to developing countries in the 2017 to 2020 timeframe?
Thank you. That's a big question. I think I would probably be a rich man if I'd be able to answer that question. There are many specific policy successes that we've been able to assess here at CPI over the years. Generally, we've always found that context is king. So when looking at specific success stories, either at project level investment or portfolio level investment from investors, but especially on the private side, we found that specific country risks, currency risk, and other access to finance risks in general are important risks to mitigate while you get the overall policy right, which is generally about maintaining there's a long-term and stable revenue source for the project and for the investment in general. So it's hard to kind of prescribe a specific catch-all policy measure that would have the biggest impact. But I would point you to some of our work, especially through the lab, which has analyzed policy frameworks as a background to whether the instruments and successful ideas will come through, as well as our effectiveness work stream in that area too.
A central focus appears to be using public finance to leverage private sources. Do you also consider how to better leverage public funds for public investment?
Yes, we do consider that in some of our analysis. We do find, particularly at the project level, we find many different forms of public finance institutions in particular are participating in the same investment alongside the private sector. And sometimes that is important. Many of these institutions have caps on the proportion of the project that they're allowed to invest in. For example, 25% or 20% of the total cost is as much as they're allowed to lend to the project. So it does help especially in developing countries where risks are perceived as high, that there are other actors that are there willing to step in. It's not a main feature of our landscape analysis. Our landscape analysis is simply looking to track the flows, what has happened, what has been invested in new assets from who and how. And at the project level, we haven't looked at the public to public split exactly.
It was mentioned that 89% of public actor climate finance is coming from development finance institutions, but also that 79% of climate finance was raised and spent in the same country. Does this mean that the majority of DFI spend is from national development banks?
Yes and no. So the majority of development bank spend is from national development banks. They are still the largest category as in previous years that we track. They include banks that are in developed markets and in developing markets. But and they are with national banks, multilateral and bilateral institutions together. They are 89% of the total public actor figures, which are approximately, if I can get the number here, that's 124 billion. So of the total public finance of approximately 140 billion over the 2 years. The 79% figure is actually more focused on the total flows, both public and private. So that is the 410 billion annual average that we assess from public and private actors, and 79% of that was raised and spent in the same country. So that includes a lot of private spending. A lot of source of private flows is derived from within the same country, from local commercial banks and from project developers or entities, corporate actors that are already present in the country itself.
How do green bonds fit in the picture of climate finance flows?
Great question. So we would pivot back to our double counting point, where we're looking to try to arrive at a non-double counted figure on climate finance flows. We want to know what is new finance going into new projects every year that is committed. And in green bonds, it's hard to decipher exactly how much of green bond financing is new financing that is comparable with that figure. Many green bonds are use of proceeds green bonds. That means that they refer often to projects that are already been financed. We've done a few in previous years' editions of the landscape. We've, for example, pointed to one or two projects where a green bond would have been issued in that given year, say, for example, 2014. But the project that is linked to that green bond was in our landscape analysis in 2012, because that was when the initial primary loan was given to the project to get it constructed. So green bonds is something that we are interested also to look at in more detail, not only to understand how much of the green bond financing that may be new, but also to understand how much of it has linked to previous primary transactions that we've tracked before, and understanding more the relationship between the green bond market and new primary transaction flows altogether.
How does the quantum of climate finance flows you've described compare with flows of finance for fossil fuel investments? Has anyone been able to calculate these as a proportion or percentage?
So we were interested in trying to compare apples for apples and oranges for oranges in this analysis, when we looked at how much finance was going into renewables and how much was going into fossil fuels. We found that there is 825 billion that went into fossil fuel investments in total in 2016. So that not only includes gas power stations, coal power stations, but also all of the upstream and downstream investments in pipelines and exploration and mining in the oil, gas, and coal sectors. On the flip side, on the green side, we have identified a significant amount of renewable energy investment, 300 billion almost on average per year between 2015 and 2016. And we compared those renewable power investments into electricity provision with the fossil investments into electricity provision as well. And they are double what the fossil investments into electricity are. But when you take into account all of fossil fuel investments, they are half. Our total climate finance figure is half that. So that's the relative quantums or the relative proportions when we're looking at comparing those two aspects.
Can you comment on problems of greenwashing of financial flows? Do you think there is any difference between public and private greenwashing of climate finance?
We have followed our landscape methodology, which is something we've developed over, I think this is the sixth edition now of the landscape. We have 5 years of good trends to analyze. The first edition of the landscape was focused on more narrowly north-south flows. So, but our global flows have been 5 years in the making. We based our methodology on a very specific project level definitions of what is climate finance. That is also often used by the multilateral development banks and national development banks in particular when they report on their green financing mapping, and is also used often by the OECD as well in reports on climate finance generally. So we do follow, in principle, these other sources of climate finance data, and that are, in many cases are checked and double checked as regards to where the finance is going and their actual labeling as climate finance as well. On the private side, we do our gold standard is on project level transactions, and so that means we do focus very much on a positive technology list that gives us a lot of clarity on the amount of climate effectiveness, you could say, or the alignment with our climate definitions that these private finance investments are going into as well. So we're quite confident on those aspects too. So we had another question there on the percentage of transaction costs that we've found that are implemented in the end use costs for renewables and energy efficiency. We don't have a breakdown of those costs in our project level data. It is something that we do analyze when we do our effectiveness case studies, and when we do our lab case studies as well around rolling out specifically new instruments and what risks, including extended transaction costs that these instruments can reduce. So I would point you to that work in particular to find out more.
Thank you. We have time for one more question, which is it still difficult to find high quality projects in developing countries for climate adaptation? And is there then a risk that funding will not be used before the commitment period expires, particularly relating to grants?
That is another great question. Also, something that we would be very interested in nailing down in more detail in the future. We haven't yet found a specific link to whether the lower amount of adaptation flows is due to a lack of a pipeline in projects, or whether it is mainly due to a methodological issue, making it difficult for institutions and other actors to report on how much adaptation finance that is flowing. So this is something that definitely needs to be looked at into more detail, and is something that we have set aside for future work in particular. It's also a question of the amount of information and awareness on the need for adaptation investments that different public and private actors might have in developing countries especially. And then their awareness of the availability of funding, such as the grants that you point out that may be available for this type of investments. So yeah, we agree that it's a very important area. There are potentially risks around those points that you identified, but we would have to look into it in more detail to have a clear answer.
Thank you. This concludes our webinar. If we didn't get to your question, please feel to reach out after the event and we can answer your questions via email. Thank you very much to Padraig for the great presentation and to all of our participants for your interest and questions. As Padraig mentioned, CPI will be hosting another webinar tomorrow on our lab programs, and I will soon post in the chat box the link to our website where you can find more information. Thank you for joining us.